In a world gripped by the relentless grip of the inflation crisis and the daunting retail crisis, the very fabric of fast food is unraveling. Join us as we unveil the story of 15 beloved chain restaurants that have closed, succumbing to the restaurant closure crisis. Fast food, in the jaws of inflation, fights for survival. Crystal, a burger chain spanning 10 Deep South states since 1932, faces stiff competition from industry giants like McDonald's and Burger King. Sales plummeted by 6.5% for 3 consecutive years. What did they do in response? CEO Paulo Macaluso tried to boost sales by introducing an all-you-can-eat burger and fries deal for $5.99. This did bring in more customers for a while, but it ended up hurting the company's profits. To make matters worse, many Crystal locations are over 30 years old and desperately require costly renovations, putting further financial strain on the company. Founded in 1951, this chain has faced some rough times before. It's surprising Jack in the Box has survived as long as it has, given all the controversies surrounding it. But what are these controversies? Well, in the 1980s, it was sued for selling horse meat while labeling it as beef. Then, in 1993, Jack in the Box was responsible for a food poisoning outbreak that left over 700 people sick, including 4 children. Despite all this, in the early 2000s, it regained customer trust and became a prominent burger chain. However, recent years have brought challenges, including rising meat prices, fierce competition from upscale chains like Shake Shack, and shifting consumer preferences, pushing Jack in the Box to the brink of bankruptcy. When Boston Market first opened its doors in 1990, it set itself apart with its delicious rotisserie expertise and a fast and convenient dining model. Customers could also grab ready-made sides and dinners. This concept propelled Boston Market to over 1,100 locations across the U.S. at its peak. So, what went wrong? Grocery stores started offering their own ready-to-eat rotisserie options at lower prices. This hit Boston Market hard, leading them to file for bankruptcy for the first time. Today, it's owned by Sun Capital, and unfortunately, Boston Market hasn't found a new competitive edge to attract customers. Sizzler is a unique combination of a buffet-style restaurant and a steakhouse. Over the years, Sizzler has built a massive following, thanks to its diverse menu featuring signature items like garlic cheese toast, generous portions of fried shrimp, and a bountiful salad bar. So why did they end up on this list, then? Sizzler's mid-20th century dining concept isn't resonating with millennials and Generation Z. Since the pandemic hit, Sizzler had to file for bankruptcy and shut down 70 locations. Today, only 80 restaurants remain, and their poor earnings indicate that more closures might be in the pipeline. Finding seafood on the go isn't easy, and it might become even more challenging as Red Lobster faces significant hurdles in getting back on its feet financially. Lower supplies and steady demand, coupled with rising labor and operational costs, have been causing headaches for this all-you-can-eat popcorn shrimp empire. To put the losses in numbers, in the past year, they expected a $10.4 million loss, but actually lost $15.3 million in a single quarter. Approximately 100 Red Lobster locations may close as they are no longer deemed viable by company executives. A few years back, Qdoba had some fun at Chipotle's expense by delivering truckloads of avocados to Chipotle stores to remind everyone that they offer free guacamole. While that was a humorous marketing stunt, it didn't do wonders for Qdoba's bottom line. With the cost of avocados skyrocketing in recent years, Qdoba has been losing money by offering guacamole as a free entree to customers. While rival chains are growing and grabbing a larger share of the market, Qdoba is seeing demand cool down. Noodles & Company started operating in the U.S. in 1995 and spent nearly 2 decades expanding and growing before going public in 2013. That's when the problems began. Since 2015, Noodles & Company has been closing stores more frequently, and its stock value has taken a hit. The business is struggling to adapt to changing consumer habits, and declining foot traffic is making it tough for them to stay afloat. Blimpie was once a big player in the sandwich chain scene in the US. During the 80s and 90s, Blimpie expanded rapidly, but this expansion actually led to problems. Many of the operators didn't meet the company's quality standards and weren't financially stable. As other sandwich shops like Subway and Jimmy John's gained popularity, Blimpie lost its appeal. From 2002 to 2011, the company had to close more than 1,000 locations. Unfortunately, it seems that things haven't improved much since then. This fast food chain's business model is under threat due to shifting consumer spending habits and worsening economic conditions. Since it's a drive-in restaurant, it's directly affected by rising gas prices. When the cost of filling up at the pump goes up, visits to Sonic Drive-In tend to go down. On top of that, it's competing with giant brands like McDonald's, Burger King, and Wendy's. It's easy to see why the chain is struggling. Quiznos's anti-franchisee policies are pushing this sandwich chain toward disaster. Operators have been complaining for years about minimal profits as Quiznos forces them to buy supplies at inflated prices. A lawsuit was even filed alleging fraud, claiming that Quiznos had deliberately modified its business model to benefit themselves at the expense of franchisees. That happened during a buyout that ultimately failed and led the company to file for Chapter 11 protection. High Bluff acquired the business and reduced its store count to just 800 locations worldwide. In 2023, former CEO Carl Wogla bid farewell to Cici's, known for its unlimited pizza buffet. He believed Cici's concept wasn't working anymore, citing high operating costs and declining foot traffic. New management initiatives like logo changes and menu updates may not be sufficient to rescue the chain. In 2018, Cici's had 430 locations across 32 states, but now only 278 remain in 20 states due to rising rents and minimum wage hikes. Buffalo Wild Wings is a place that offers fun, food, sports, and a cozy atmosphere to hang out with friends. But despite having all the ingredients for success, profitability has been an issue for years. What seems to be the problem? A chicken wing shortage and higher prices hit the market, making matters worse. Increased menu prices also drove sales lower, just when competitors like McDonald's and KFC kept offering wings at cheaper prices. Recent consumer complaints about declining product quality have added to the company's troubles. While donuts can be found in thousands of bakeries, convenience stores, and grocery stores across the country, Krispy Kreme is still the go-to donut shop for millions of Americans. Then why is the company in financial distress? In 2022, the company closed several underperforming locations, helping them save on costs during a period of disappointing financial results. While this move offered some short-term relief, CEO Michael J. Titusfield recently announced layoffs as the chain plans to increase automation in its stores to reduce labor costs. This suggests that Krispy Kreme's financial problems are far from over. According to MASH.com, Taco Bueno has fallen victim to a peculiar trend in the food industry known as the taco takeover. What is the taco takeover, you ask? It's a trend that started when major investment companies saw the potential of taco joints and poured money into them. In 2014, Rusty Taco was acquired by Buffalo Wild Wings, later bought by Arby's. Del Taco was purchased by an investment firm, which then launched an IPO. However, Taco Bueno took a different path after a middle-market Dallas firm bought it and aimed to rival Taco Bell. This led to Chapter 11 bankruptcy. Sun Holdings, a national franchise company, later rescued Taco Bueno, but financial challenges persist due to oversaturation in the taco business. Finally, let's discuss Papa John's, a once popular pizza chain that's facing a significant downfall. The reason for the demise isn't poor quality or customer complaints. So why is it facing trouble then? Its former CEO, John Schnatter, is playing a key role in this fall. Schnatter's controversial non-pizza related comments, including remarks about NFL players, led to his resignation as CEO, even though he still owned a substantial portion of the company. Things worsened happened when Schnatter used a racial slur during a conference call and then tried to regain control of Papa John's. Revelations about a toxic corporate culture and harassment allegations further increased their troubles. The company's reputation took a hit, resulting in major losses, including losing its NFL partnership to Pizza Hut. To support struggling franchisees and repair its image, Papa John's had to make significant expenditures, impacting its stock negatively. Unfortunately, Schnatter's ongoing attempts to regain control and public criticism of the current leadership leave Papa John's at risk of disappearing from the market. These restaurant chains are far from being the only ones in trouble in these trying times. Click the video on screen now to find out how even giants like Amazon are in deep trouble.